Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, May 30th, 2023, and I'm pre-recording this Trading Places Live for a bit later this morning. Currently, we have futures a little bifurcated. Let's see here. We got the Dow Jones futures down 23, S&P 500 futures up 22, NASDAQ futures up 184 points. So we've got NASDAQ futures up over 1.25%, S&P 500 futures up about 0.5%, and the Dow futures down about 0.1%. So definitely a little different market action here as we get ready to open, depending on which index you're looking at. Crude oil futures down, or crude oil prices down about 1%, back down just below $72 a barrel. And that U.S. 10-year Treasury yield that had a big move up last week, down 11 basis points this morning, 3.71%. Of course, the big news over the weekend, lawmakers reached a tentative debt ceiling deal. Now, of course, they got to take it to Congress, see if we can get this passed. But I know the media has been talking over and over and over and incessantly about this debt deal. All I have to say about it is it gets done every single time. Every single time. We've not had one time when it didn't get done. So all the talk about it and all the market's up because they're nearing a deal, the market's down because there's a stalemate, all that was just taking up time and wasting all of our precious time. But hey, if you want to talk about it, fine, go ahead. Once again, it was just worthless media chatter. The deal's going to get done, whether it goes through the Senate, the House, whether it has to go back, doesn't matter. It's going to get done. And that's the way I approach the market. I certainly don't look at the market. I think I read something where there were 79 times that this has come up where we've had a real struggle, and 79 times it's gone through and we've gotten a deal done. There's no other option. It has to get done. So anyway, all the talk is just that. Got semiconductors on a roll again this morning, leading the NASDAQ to the upside. NVIDIA, I saw earlier, was up another $15. We got some other areas of the market joining in. We got Tesla up $6-7, I think, this morning, at least earlier this morning it was. So we'll see how the day unfolds, but it looks like that the aggressive side of the market, especially the large cap growth, that area of the market continues to power ahead, and it's literally lifting the entire market up, carrying it with those large cap stocks. So you can go for the ride, you can make excuses that hey, it's just the large cap stocks. You can say whatever you want. Market's going higher, continues to move up, broke out. The NASDAQ not only took out the August high, the NASDAQ is not too far away from its all-time high. It's starting to get closer and closer. I mean, that was up around that 400 level on the QQQ. I think currently we're at like 352 or something pre-market, maybe 353. Let me see where exactly we are on that. Uh, 353 and change. It's up another 1.45% today. The semiconductors just having another huge pre-market session. We'll see whether or not that translates throughout the day. But the semiconductors had reached 92.28 as of the end of last week. 92.28. And currently, let's see what we got here. Yeah, the all-time high on the Dow Jones U.S. Semiconductor Index is just over 9,500, 96, close to 9,600. We're at 92.27, and that's before today. We're going to be getting up close to the all-time high on the semiconductors. You can say what you want about all the various groups and what's leading and how many groups are not following suit. There is no index that I follow more closely than the semiconductors. It's an aggressive group. We have chips in just about everything these days. I think it's a great leading indicator, and it is absolutely flying right now. So again, say what you want. I look at the charts. Been talking about this for a while. The market's going to go higher. Are we going to pull back? Sure, we're going to pull back at some point. But I think when we pull back on the NASDAQ, I think you're going to see money rotate. I don't think that money's leaving the market. That's when you're going to see the S&P begin to move a lot quicker to the upside. I think you'll start to see some of the small, mid caps start to make a move as well. Right now, it's all about large cap tech for the most part. And again, that'll at some point that'll come to an end. We'll see some rotation. And I think a lot of that money rotates back into some of these other areas and we get big breakouts there. Let's go ahead and go through the agenda real quick. I know I spend a little time there, but it's always worthwhile, especially with big news coming out of Capitol Hill. So we're going to start off today with the daily market recap, then jump into talking technically, chart of the day, consumer stocks, earnings spotlight, and the 3 you must see. Got a ton to go over those, so let's jump in. First, daily market recap. Dow Jones Industrial Average on Friday, up 1%, 328 points. S&P 500 up 54, that was 1.3%. NASDAQ was up 277 points. That was almost 2.2%. Mid caps up almost 1%, up 23. Small caps up a little more than 1%. That was up 13. We can see AD lines remain strong on the excuse me, on the 3 major indices. And you got mid caps starting to turn back up. Same with small caps. They got a little bit more work to do. Among the sectors, technology, discretionary, communication services. I can't think of 3 better groups to lead the market to the upside. They were exploding higher on Friday. That's what was sending the NASDAQ up. Also moving higher, real estate, which was up over 1%. And the primary laggard, energy, which was down about 0.4%. Energy remains under pressure. I do believe this is in the group, though, that will get a lift probably sooner rather than later. We do have a little bit more room to the downside before we hit some key support levels. But I would think somewhere in the 75, 77 range, we're likely to find support on energy. And we're currently at 78, 77. So there's not a whole lot of downside room. Maybe we go a little bit lower this morning. As I said, futures or crude oil prices were down. So that may lead to a little bit of weakness in the energy shares to start out. But I really think that 75, 77 area is going to hold. And then we'll see a little bit of a rebound. How much? I don't know. This isn't a group that I think is going to lead us in the balance of 2023. But I do think it's a group that will likely hold support and move higher. 10-year Treasury yield. This morning, as I mentioned, not showing it up yet on this chart, but we're currently seeing the 10-year Treasury yield down about 11 basis points, down closer to 370. And that still is above the rising 20-day. So we still remain in this uptrend. But if it's like all these other tops and even the bottoms, doesn't seem to be a real lengthy trend. I would say overall, we're trending lower by these lower highs and lower lows, but it's been a pretty mild drift to the downside. We get these big breakouts, they fail. We get big breakdowns, they fail. Currently, we're in an uptrend, but like I mentioned, down 11 basis points this morning, back down closer to 3.70%. Later this morning, we've got the March Case-Shiller Home Price Index coming out, looking for a drop of 0.1% there. February rose 0.1%, so a little bit of a move to the downside. Also, downside expected in the March FHFA House Price Index. February rose 0.5%. March is expected to climb just 0.3%. And then May consumer confidence expected to drop down to 100.0. April was 101.3. So we are looking for a little bit of deterioration in those 3 reports as they come out later this morning. Moving on to talking technically, S&P 500 went back up above the 4,200 level to 4,205. 4179 was the level I had been looking for previously. That was the high on February 2nd. We did get above that, traded above, closed above 4179 3 straight days, pulled back, and even had one head fake below the 20-day moving average. Now right back up, moving back to 4,200. And if futures are any indication, we're going to easily clear the recent highs. Looks to me like 43.05 which was the high from August. That is going to be the key level as we move forward. I expect the S&P 500 to move up to challenge that level in time, probably here in the next week or two. NASDAQ 100, looking at the chart, I mean, there's no doubt we are completely in an uptrend. Continue breaking out, trading above the 20, which is rising above the rising 50-day. Even volume soared at the end of last week to accompany this next gap up and breakout. NASDAQ looks really good. And if we pull it out to a weekly chart, I mean, I don't know how you can cling anymore to bearishness. Looking at the NASDAQ chart, we're now back up above 14,000, way above the August high. Looks like maybe this move could go up to about the 15,000, maybe a little above 15,000 level. That's where we had a couple of tops. We reversed back to the downside. I expect we're going to probably get up to the 15,000 level, maybe a little above, and then possibly pull back to 14,000. And I think if we do that on that pullback, I think you're going to see money rotate back into areas that have not been performing as well. And I think we're going to get breakouts in those areas as well. So let's keep moving. That is talking technically. Want to get into the chart of the day. For those of you who like looking at a chart of the day, I would strongly suggest you head over to earningsbeats.com, our website. If you scroll down, we have a free newsletter, Earnings Beats Digest, where we cover a chart 3 times a week, Mondays, Wednesdays, and Fridays. Just simply type in your name, email address, hit that subscribe button. We'll get you set up. No credit card required. You can unsubscribe at any time. Usually talking about earnings, relative strength, those sorts of things. Today, though, I want to talk a little bit about, and by the way, we have extended our membership special, spring special, through May 30th. So you have through today. So if you haven't acted up till now, you got one more chance. Midnight, it's over. Lots of savings available. We've had a great run in terms of market guidance over the course of the last few years, really throughout the pandemic, especially the last couple of years. That's a big part of our service, along with the market guidance, along with research and education that we provide. So make sure you check that out. All right, let's take a look at today's chart. And this is something I've been talking about recently. I think this is huge. The equity-only put-call ratio, this is what I like to call my Freightliner sentiment indicator. It's a 253-day moving average, but when it changes direction, you need to pay attention. Here, you can see we peaked. That was at the end of the financial crisis. The higher this ratio goes, the more panicked the market is. So here you can see the end of the financial crisis was the highest we've seen, which makes sense. That was the most panicked we've seen in the last 20 years. It's the most panicked the market has seen, at least since 2005. So anyway, we got up to the peak. When we rolled over, S&P 500 took off. When we got to a bottom and the market got too complacent and we turned back to the upside while we were going up on this, the market struggled. Then we rolled over and went lower again. Throughout the entire period of going lower, S&P 500 had a huge move. Then as we go higher, meaning the market's getting more fearful, market doesn't do very well. We peak and we come back down. So the market reaches its pinnacle of selling, of panic. Once that turns to the downside, market takes off again. I mean, these kind of coincide, but there's a lot of choppiness. So I would just, 2018 to 2020, it worked, but you had to be prepared for some very quick whipsaw, which is unusual for this Freightliner. You can see it normally moves in the same direction for a long period of time, usually for at least a year, year and a half, sometimes 2-3 years. In this case, we've been going up now for a year and a half. I said May, late May was when I thought we could start to see this thing roll over. And there you go. It's in May. It's starting to roll over. And like I said, when we roll over every time, think about this level of sentiment being, hey, everyone's bearish. If you wanted to sell, you've sold. I mean, I don't know too many bears that are sitting long 100% still. Everyone has sold. And when a market gets sold out, you have nowhere to go but up, which is what we've been doing. And now as we go up, the bears, those have been buying puts, all of a sudden are starting to think, wow, we've gone up 800 points now. Maybe I'm wrong. Maybe the market's not going to go back down. And you're starting to see a few more of those bears become a little bit bullish. We've seen it really over the last few months, but more and more people are starting to say, hey, you know what? Market's really starting to move. Maybe I should get in. Well, the good news is there's still plenty of folks out there on the short side and in puts, which is evidenced by this ratio. But it's starting to roll over. And I want to show you something, because if we take out, let's just get rid of this moving average. And instead of an invisible chart, let's go back to candlestick chart, or even we can probably do a line chart. I want you to look at what's been going on in the equity only put call ratio. Here's where we started trending down because everything got so bullish in 2020, 2021. Just too much. Everybody was throwing everything they had. People who had never invested before were getting in and going long. Wall Street bets, all the meme folks, all those meme stocks, everything was going up. Couldn't get enough of it. Stock market was everyone's personal ATM machine. It was too much. That's why going into 2022, looked like the market was topping. Talked about that. But look at this move back to the upside. Now, I wanted to show you this, because these were unreasonable readings, because professional traders started buying huge amounts of puts as hedges on some of the larger names like Apple, Microsoft, Tesla, Nvidia, and so forth. The thing is, this was not showing fear. This was not, I use the CPCE to measure the sentiment of retail traders. These were professional traders that were sending this ratio higher than it should have been. This day when it hit 240, that was a big up day in the market. There was no panic. It was just hedges. I mean, it might have been big buying of the underlying stock and then buying puts to hedge. I don't know what they were doing. But my point is, it was way too much. We needed to take that out. And you could see it by the half-hour readings over at the CBOE. It would be over 2 or 3 half-hour readings in the middle of the day. Normally, the call and put buying slows quite a bit in the middle of the day. There's usually not a whole lot going on. Well, there were about 10 different days where the puts jumped. And just, if you didn't follow it, you never would have believed it. How much the puts were jumping in the middle of the trading day. So I wiped them out. Not all of them. I left what was normal in there, but I took out the huge jump. And when I did that, I want to show you the user-defined chart that I came up with. And I want you to look at where this sits, because this is taking out all of those November and December readings that really sent this thing spiraling to the upside. And when I take that out, look at what we're doing right now in May. Exactly as I suggested we do, we're starting to roll over. And we've been rolling over for the last couple of weeks. What's the market been doing? Exploding to the upside. This is just getting started. When I said we're going to be bullish for the next few years, and I see S&P 500 8,000 coming probably in the next handful of years, this is one part of it. It was the same reason why back in January, I go back, just get rid of this. Let's go back over here. So if you notice, beginning of 2022, what was it doing? Down at the bottom, it was just starting to roll over. I said at the beginning of 2022, sentiment was the biggest problem going into the year. And look what happened. We needed this to reset. And this is what it took. And this is what it took the market to reset. Now we've reset and we're rolling over. those who want to stay in the bearish camp, I wish you the best of luck. Let's move on. Consumer stocks. So here, basically what I wanted to do is just show you, here's the XLY. So we had a big move in January. We've basically been going sideways here for a little bit. I see a really kind of unorthodox, hard to see, inverse head and shoulder, left shoulder, neckline, head, right side of the neckline, right shoulder, and now we're coming up. I think we're going to get the breakout. I see XLY taking off here, which will help some areas other than just the NASDAQ 100. Got a lot of consumer discretionary names and small caps, mid caps, and so forth. So that'll help we get that when we get that breakout. But on the other hand, we have the XLP. And the XLP has rolled over big time. If you want to see what's going on in the market here in May, I mean, just look at the XLP, which was up near 78 at the end of April, early May. It's rolled over. It's completely fallen apart, which was to be expected. And look back at the XLY, and the XLY is going up. So it's the perfect scenario for the bulls. Markets going up, being led by consumer discretionary versus consumer staples. It's sustainable. This rally is sustainable based on that relationship. Now, looking within the various, well, these two sectors, XLY, there are a lot of industry groups to follow. One, hotels. Hotels, this is a relative chart going back 3 years. Hotels relative to the S&P 500. So which groups, if the XLY is going to lead to the upside, which groups look pretty good? Well, hotels, as long as it holds on to this relative support level, I would be expecting this group to move back up. Toys, not so much, still struggling. Restaurants have looked good, although they've pulled back in May. I expect them to regain some strength here. Specialized consumer services, been rolling to the upside. I think this group still looks good. Clothing and accessories, no thank you. This is a group that really struggles over time. You can find some individual names that do well, but this group as a whole really struggles. Home improvement, not really getting much support there. Recreational services, this isn't doing badly. I mean, this includes areas like the cruise lines. They've been doing better. I think we need to take out this breakout from February where testing of this resistance level. We need a breakout. Still got a little work to do there, but not looking bad. Apparel retail, throw them in with clothing accessories. I probably wouldn't do too much relying there. Specialty retail, though, has been moving up. I'd like to see it hold about this 0.53, 0.54 level. And we're at 0.54 and change right now. Travel and tourism definitely has picked up, pulled back a little bit. I'd like to see travel and tourism strengthen again. Gambling stocks, this has rolled over, and this one's starting to bother me a little bit. I think this breakout right at about 0.145 needs to hold. Got the 50-week moving average coming up from underneath. Watch for that. Home builders continue to be strong, even though they've pulled back a little bit recently. Broadline retail starting to strengthen. We're seeing it in Amazon. I think this is going to be a big group in the balance of the year. I expect this is going to continue to the upside. Now, what I would look for maybe to negate what I'm seeing right now would be this to turn back over and go back below both moving averages. See that PPO turn negative again. But if this continues like this to the upside, this is going to be a big area to help carry the market. Amazon, I really like. Furnishings, the furnishings index, not really doing a whole lot right now. Footwear was really hot, completely falling apart here in May. Got to be careful with that group right now. Training, business training and employment agencies, not really been strong for quite a while. Same goes with durable household products. Automobiles, watch this one starting to turn back up above the 20. Still got some work to do. Tesla's been strengthening, though. I know Rivian has been strengthening. I talked about that in a recent report to members. I really like Rivian. Recreational products, not so much, down near a multi-year low, relative low. And then auto parts, not so good. But what about staples? You know, staples have been rolling over. What are those groups looking like? Well, we have a double top in the brewers starting to roll over. That needs to hold on to the moving averages. Food, Products, this has been a group that's done very well. Falling apart in May. Watch these support levels. Already below the moving averages. PPO starting to turn negative. That one I'd be a little careful with. Soft drinks was strong. Now that's fallen apart. Drug retail back at the end of the year looked as strong as just about any group. Remember the fourth quarter, we had a lot of value stocks doing well. These drug retailers were on fire. 2023, not so kind. Personal products falling apart. There are some stocks that are in this industry group I like. One is Costco, which broke out of a pretty important symmetrical triangle on Friday. But the overall group, not so much. Non-durable household products rolled back over, not really looking very good. Then we've got food retailers and wholesalers trending below the 20-day, which is below the 50. Negative PPO, not looking good there. Tobacco falling apart, not looking good. Tires had a big move at the end of April and to start May. That's kind of rolled over, failing to get through that resistance area. Vintners, distillers, also not looking good on a relative basis. And that's it. It's hard to like defensive groups. If we're topping, Wall Street would be moving into those groups, folks. We're not topping. Money is pouring into aggressive stocks. To me, it's pretty obvious. Market's going higher. But again, that's my take on what I see. Let's move on to earnings. Got to get through here pretty quickly. ESLT, this one just reported this morning. Let's take a quick look at where we're currently trading, up 7%. Really big move. Stock had made a huge run, pulled back right before earnings, now going right back up near that high. That's a pretty nice looking chart. The other one reported this morning is Sky. This is Skyline Corp. This one's pulled back near support, and it doesn't look like it's doing a whole lot here, but I would really like to see this 62, 64 area hold as support. All right, 3 you must see. What I'm going to do is I'm just going to go over to the S&P 500, and I'm going to pull up 3 weakest stocks from Friday. So we got Ulta, we've got KR, and we got ES, so Kroger. But let's go ahead and pull up first Ulta. So just the 3 worst performers from Friday. Ulta had already rolled over, had lost some key support. The volume was starting to pick up on the selling. Not really too surprised by the huge move down after earnings. 6 million shares. I think it's probably heading back down for the lows we saw in the second half of last year. So I don't see anything until we see a reversing candle. It's hard to get behind this one. Next is Kroger. Kroger also rolling over, losing moving averages. Watch this area of support around 46, 46.5. I think that's where we're heading there. Last stock is ES, which is Eversource Energy. Breakdown with increasing volume below the recent lows. So a 52-week low. It's in a group not performing well. This stock is not performing well. Not interested. Got to see a big reversal first. All right, that's it for me. Got another gap up, especially in the large cap growth, getting ready here to hit us beginning of the trading session here on Tuesday morning. I will say this is one of the most bullish periods of the year historically. After Memorial Day holiday through the first week of June. Market's looking better, getting the gap up. History supports further upside. If you're a bear, be careful out there. Happy trading, everybody.